What's up, guys? Back with another video today, but today I wanted to get into things that are really important when it comes to your investment profile and investing in the stock market, etc. So long-term and short-term capital gains taxes. So let's talk about that. Long-term capital gains. So it's when you realize profits that are held for 12 months or a year, plus 1 day or longer, trade date to trade date. You have long-term capital gains, short-term capital gains. So the long-term capital gains that I just talked about is taxed at a capital gains rate of 15%, because in the market, you're made to invest for a long period of time. That's what companies want to see. That's what government wants to see, that you're in it for the long term, because historically, the stock market goes up on average every year, despite having down periods. If it goes down, it always bounces back. But if you're not in it for the long term, let's say you say, I want day trade, get short term, I don't care, just want to make my money. That's all you do, your thing. But here's the information you have to understand. That long-term capital gains is more beneficial to you if you want to hold in for the long term. If you want to hold in for the short term, I get into that in a little bit. But let me give an example. So the long-term capital gains, say if you have $3,500 that you just have a long-term gain on, okay? And you're in the 24% tax bracket. And you say, well, what's my liability for taxes then? Well, I just said 15%. So let's say you take that 3,500 times the 15%, you get $525 of taxes that you are a responsible person for. Now, let's say if you're in the highest marginal tax bracket. So you're saying, well, what do I pay for long-term capital gains? 20%. So basically, as I was saying back in my retirement video, if you want to be in the highest tax bracket, you're going to get taxed more. That's just how it is. Rich get taxed a lot, but it's because you make a lot of money and you're going to owe a lot of money to IRS. So let's talk about short-term capital gains. Let's say if you're saying, I don't want to hold this stock for years going down, I want to take my profits already. Do your thing. The realized profits held on assets 12 months or less trade date to trade date, they're taxed at your ordinary income tax rate. So let's say you have that $3,500 again. Let's say you're in a 24% tax bracket though, and you said, nah, I don't want to hold long term, I'm doing it for less than a year. That 24% tax bracket is going to come back to bite you. You will have $840 to be a responsible person for. So what am I trying to say? Long term, that's the whole plan. That's the whole basis, synopsis, that's what it is. When you're in the stock market, the overall big picture is for you to invest long term. So hold it for a year or more. Some things may go up, some things may go down, but you got to do your due diligence. That's the main thing about investing. Do your due diligence on a stock before investing, because if you want to get in when it's a pump and dump, when you want to get in when people are buying it up and then you're about to go in at the top and get erased, and when everybody else takes their profits at the top, you're at the top saying, I bought in, let's keep going forward. You got to understand, the stock market is not a game. Sure, the 2020 fiasco had everybody thinking, man, we could do a lot of things in the short term. But at the same time, people are responsible for a lot of taxes. So if you want to have a long-term capital gains tax, 15%, there you go. That's going to be taken off you because you held it for a year or longer. And if you're in the highest tax bracket, 20%, cool. But if you hold for short term, whatever tax bracket you're in, that's going to come back to bite you. So if you want to hold it short term, you can do it. You want to pay it, cool. You make your money. But at the same time, if you believe a long-term solution is best for you, go long-term. But I didn't tell you what to do. I just told you, if you want to do it, you can do it. I'm not giving you advice, just telling you information. But let's say if you take a loss on some things, because some of us here may have taken a loss. I've taken a loss on some stocks because simply things happen with the company. But what happens with losses when tax season comes around? So you always got to net your total gains and losses, including losses carried from prior years. And your net losses may be written off. Against ordinary income up to a maximum of $3,000 per year. Maximum of $3,000 per year. Anything that exceeds $3,000 may be carried forward to the next year. The loss carried forward is first offset against your net gains in that year, and then may be written off as ordinary income up to a maximum of $3,000 a year for individuals. So basically what I'm trying to say is that it's better for you to invest in the long term. And if you see something going downhill after the long term, then you go ahead and have a loss if you took a loss, or if you're taking a profit, you take a profit. Sometimes when we invest, we want to get things right away, but then again, you have to understand taxes will come back to eat you up very quick. So like I said, if you're doing something for a long term, get the 15%. Highest tax bracket, get the 20%. But if you're doing something for the short term, you're going to get taxed in your tax bracket. So let's say you're in a 30% tax bracket. You could just wait it maybe a couple months. But if that's not your plan, that's not your plan. So I'm not telling you what to do. Like I said, I'm just giving you information. So If you feel like it's necessary for you to do a short-term capital gain and just want to take your profits immediately, that's what you want to do. But if you want to go ahead and do your long-term, that's what you want to do. Like I said, the whole broad big picture of the stock market is long-term investing, because in a way it's supposed to set you up for retirement. It's supposed to teach you how to invest and where to invest, because you're going to have those things or whatever stocks or whatever portfolio diversification you want to have within your IRAs, etc., within your retirement accounts. Same thing may be said for your brokerage accounts, your regular ones that you just want to invest in. So always remember, long-term versus short-term capital gain taxation, regardless, you're going to get taxed. So guys, like I said, this was a short video. Thanks for watching, and I will catch you guys next time.